Hello and welcome to Financial Intelligence. In this video, I want to talk about the fact that day trading stocks is in reality a negative sum game. The term negative sum game describes situations in which the total sum of gains and losses is less than zero, mainly because the party that facilitates the game charges both players for their participation. What this means is that since there are costs associated with day trading, the total amount gained by the winning day traders is less than the total amount lost by the losing day traders. In other words, the day trading community in aggregate is unprofitable because there are many costs that they need to pay in order to participate in this game. The house always wins is a popular saying describing how casino games have an inherent bias toward the casino or house, described as the house edge. In the case of day trading, the house is the collection of financial institutions that makes day trading possible. Since they will charge both winners and losers, they have an inherent edge. Gamblers or day traders in this case might win from time to time, but in the long term and in aggregate, they will lose. In this video, I want to share with you three main costs associated with day trading that make this activity a negative sum game. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Cost number one, transaction costs. Now that commission-free trades for stocks are the industry standard among top online brokerages, many people assume that there is no transaction cost involved when stocks change hands. Nothing could be farther from the truth. In reality, there are a lot of players who are involved in facilitating those transactions, and all of them make lots of money. The real transaction costs are hidden to give traders the illusion that it is free to buy and sell stocks, and to entice them to increase their trading frequency. The transaction costs are one of the main reasons why day trading is in fact a negative sum game rather than a zero sum game. The transaction costs are hidden from day traders because they're included in the bid-ask spread for the most part. As you know, there is always a difference between the price that you pay for stocks when you buy them, in other words, the ask price, and the price that you receive when you sell them, in other words, the bid price. For example, if you buy a share of company XYZ by paying $100, the person who sold it to you will receive only $99.50, and the financial institution that facilitated the trade will pocket the delta. The bid-ask difference is the price that day traders pay for the transaction. Online brokerages that offer commission-free trades charge day traders hidden commissions through imposing larger bid-ask spreads, which usually go unnoticed. Cost number two, short-term gain taxes. Day traders who make money during a tax year are supposed to pay taxes on their gains. Since most day traders rarely hold their positions for longer than a year, their profits are taxed at the short-term capital gains tax rate. Short-term capital gains and losses are those realized from the sale of investments that you have owned for 1 year or less. Short-term profits are taxed at your maximum tax rate, just like your salary, up to 37%, and could even be subject to the additional 3.8% Medicaid surtax depending on your income level. On the other hand, day traders who lose money on aggregate from trades done during a tax year are allowed to reduce their taxable income up to $3,000 in non-investment income. The reason that I mentioned this limit is to show you that day traders who make money are taxed on the full amount of their gains with no limit. However, day traders who lose money are allowed to write off only up to $3,000 of those losses. Therefore, assuming that the amount of gains by winning day traders and losses by losing day traders are equal, the government also makes money from day traders. That is because the government taxes the winners at the short-term capital gain tax rate and allows the losers to only write off a small fraction of their losses. Cost number 3, miscellaneous costs. There are also miscellaneous costs associated with day trading that are paid by both the winners and the losers. The first one is the amount of time invested in day trading. Many hours are dedicated to watching the charts and analyzing trends. Since those hours could be spent on other activities, there's an opportunity cost associated with day trading. The second cost category is the amount of money spent on courses, books, and tools. Many traders invest a significant amount of money on buying courses and tools that are supposed to help them become successful day traders. Last but not least, there is a cost associated with the mental energy invested in day trading. Day trading is an activity that can significantly drain your mental energy and cause excessive stress. The health costs of engaging in day trading is something that many day traders overlook. In summary, I believe that day trading is a negative-sum game. That's not to say that there are not any successful day traders out there. However, I believe that it is a very competitive game and only a handful of people can become successful at it. I hope that you like this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to like, subscribe, and hit the notification bell so that you don't miss any of my future videos. Thank you and take care.